There we go. Good. Good to see everybody. Anthony, Wayne, David again, Christine, Agatha, Barb, and everyone else. Thank you guys so much for coming out today. We have a special guest lined up for us today, a master of technical analysis, so to say. His name is John Seville from Acorn Wealth. And John, obviously, what he does is that he is the tech analysis king. He's been studying technical analysis for the past 11 years, specifically within North American equity markets. So the topic of today's discussion that John is hosting for us so graciously today is capturing the crash. He's going to go over the major market threats that the talking heads have not told you about yet. So what you see on news, they're really hiding from you. And John's really going to go over that using technical analysis today. And essentially how our smart money indicators, how they work and what they're saying. And of course, with that as well, in John's webinar today, he'll be going over his 3 favorite stocks and options that he's found in regards to trading the volatile market as it is. So John, are you there?
You're loud and clear, Josh.
There we go. Perfect. The floor is all yours, John.
Yes. Terrific. Well, you're going to have to start writing my resume. It's a great introduction. uh, Thank you everybody for sticking around today. Thanks, Josh, for that great introduction, and everyone at CTU for having me. And look, today is a very special day. We are in some very unique market conditions, as I'm sure you're all aware of. And this is something that I'm very passionate about, and something that we've been kind of crowing for the last 3-4 months that we thought was coming. And that is what we call the big one, or crash. Just as a show of hands, how many people here have felt fundamentally that for a long time the market was due for a significant pullback? Perhaps since 2012, maybe 2010, but how many people here? Yeah? Absolutely. Well, we've been feeling this way since 2012, and I've been burned on a couple of trades trying to get the cart before the horse. But the difficult thing, of course, when you're looking at fundamentals is the timing. It's kind of like looking at the tree and knowing that the apple is rotten, but when will it drop? And that's the question we ask. So as we go into today, we're going to be talking about live conditions, and we're going to talk about live stocks. But of course, it is for educational purposes only. There's a securities advisor. And stock trading does involve risk, if you did not know that already. Okay, so remember this. Remember the Christmas rally? It's all fallen apart, and that's the thing that we have to be wondering about, is when do the fundamentals catch up with the technicals or the timing? The whole time this market's been rallying since 2012, 2013, the smart money has been selling. In fact, if you look at the insider sales versus insider buys over the last several years, the average ratio that I've been noticing is about 13 sells to every 1 buy. And that concerns the world, the ones that buy the bonds, the ones that know what is actually going on in the economy. If they're not confident in their own companies, then why would you be? And that's the question. And so all we see is noise. We see constant pieces of information that's designed to part us with our judgment, to make us react emotionally versus technically or rationally. So let's get back to the reasons behind the problem. Now, these reasons haven't changed for a while, but let's define them as they are now. We have the Asian economies. Now, everyone is concerned with China, and of course we should be. It is a big part of the world's economy. The thing that we should be concerned with is the European economies. We have problems in Brazil, we have problems in France, we have problems with Italy. I mean, there are problems everywhere. If you look at any of the worldwide exchanges, the Bovespa, for example, is plunging. If you look at most of the worldwide exchanges, they're also plunging. The Hang Seng hasn't been able to hold on to any gains, and this is the problem. So the next stage is what happens next? What is the catalyst? Because everyone can always stand by and say, well, you know what, it's all okay because nothing's happened yet. But everyone says that until the problem happens. If we remember Lehman Brothers, it was already too late by that point because everyone was wondering, well, is this the bottom? Is this a once-off? Should we chase the shorts here? What we need to do, what we need to learn from 2008 is how to look at the predicators. So if the problem occurs, what happens next? Well, we look at highly leveraged companies that can possibly go bankrupt. When the first bankruptcies start to happen, and they probably will, we get credit tightening. Companies now find it hard to borrow. Consumer credit contracts. People don't want to spend money anymore. In fact, one of the best shorts that we had last year, I guess now, and the one that we've re-entered this year is on Polaris. People just don't want to buy snowmobiles when credit is contracting, especially not on the type of interest rates they're offering. So the next effect this has is that as this starts to catch up with the market, liquidation starts to happen. So people say, well, I'm a little bit scared. I don't think that there is as much upside as there is potential downside. And they say, well, I'm pretty happy with these levels. I'm going to sell out of my mutual funds. And those mutual funds, which are mostly held in, say, ETFs, then start to sell, and there's no buyers, right? The high-frequency traders only revolve around the market. They might make up 80% of the buying, but they do need to engage actual people in that process. And when the people all start to sell, the dominoes all fall at once. And investors, bond buyers no longer start to accept the P/E ratios that are being offered. And the $600 trillion of speculation in the market bursts. Now, if you don't know how much $600 trillion is, it's all of the real estate in all of the world plus. That's how much gambling in the stock market is going on. So this is why high P/E ratio companies are falling. This is why we've seen Priceline finally drop over the last few days, despite how strong the market makers are that are behind it. It's been in a steady head and shoulders pattern for the last 3 months, if you've noticed that. So these are the things we need to look at. And if you talk to most Fortune 500 companies, what they're doing is they're selling. They're selling assets. They're going into protection mode. And that's what most people are concerned with, is stay in business. Okay? So what is the theory of insanity? We've all heard this. It's the idea of doing the same thing. Is what were the things that we learned back in 2008? Now, just a quick sound check. Is everyone hearing me okay? Or is it breaking up a little bit? Okay. How's that? Is that coming in clear? Okay. Let me know if it does. It's coming through on my end, but I do. Okay. Let's go with that. Okay. So what we have to look at is, what did we learn in 2008? Um, did we learn anything? Because it's so easy to get caught up in the high of a rallying market, and we've had that for a while. But what we have to look at is, when does the hangover catch up with reality, if you know what I mean? It can't always be the hair of the dog. And these are the things that I want to talk about tonight. So let's switch over. Okay. Now we have everyone. What I'd like to ask everyone is, when we consider where the market's going, and we talk about I heard Josh talking about the high frequency trading. Um, we have to consider the role of the high frequency and how they operate. Now, there are many patterns within which the high frequency traders operate with, and there's about 100 commonly known patterns, maybe a little bit more. Most of them are derived through consolidation patterns, momentum patterns, or breakout patterns. So when we look at the S&P 500, our first question should be, what pattern is it in currently? Does anyone have a guess as to how we feel the S&P 500 is shaping up right now, as it is today? What pattern is it in? I see a couple of Acorn students there. Well, if that is you, Scott, and Karen. Okay, I would argue that it's in a head and shoulders pattern. So here's the reasons why. Let's go back firstly to 2008. Let's take a bit of a history trip. Let's go to a weekly chart. Excuse me. There we go. Okay. So let's go back all the way here to 2008. Okay. So I'm magnifying the chart. Let me know when you will see the 2007-2008 chart of the S&P up on your screen. Everyone got it? Okay. So what you'll see is that if we go back a little bit, the S&P 500 had maintained, I'm just going to make this a little bit bigger. I'm sorry, just 1 second. Let's wait for the screen to catch up. Okay. The S&P 500 had maintained an uptrend. And when we finally started not respecting that uptrend was when we broke out in March of 07. Now, when that happened, the S&P 500 started to form a different type of pattern. So the key thing when you're looking at a chart is to figure out, when does one pattern end and another begin? That's one of the most important things that we need to realize. And I've got that misdrawn there. That's when the pattern broke out, was right there, and something new started. Now, what happened afterwards was a head and shoulders pattern, as you can see clearly here on the chart. Now, if we were to measure that head and shoulders, and then duplicate it, you'll see that that is the exact distance. And then what happened? Then we had another declining neck, head and shoulders right afterwards, which was slightly larger. And you can see I've already got that drawn out. I'm pretty sure it's the same measurement. There we go, yep. So then the S&P 500 was told by the high frequency trading that it was now going to drop from 1150 down to 1,000. And that was where new support or resistance would be established. And it did. And it reversed down, popped back up, and then created an inverse head and shoulders pattern, which if you measure right there, was an inverse head and shoulders pattern, which dictated a breakout to 1200, which is where we went. Can everyone see that pattern? Is that clear to everybody? Okay. So, what's next? Let's talk about the money flow. Let's talk about the detection of smart money in the market. The smart money in the market is all about talking about the detection of where institutional or hedge funds or mutual funds are going. Now, most people define an uptrend as higher highs and higher lows. The problem with that is that it's not. It's technically correct, but higher highs and higher lows can be deceiving. What if you have higher highs and higher lows, but the range is contracting? What if you have higher highs and higher lows, but the volume is dropping? What if you have higher highs and higher lows, but it's closing lower and lower and lower in the range, accompanied with lower volume and a contracting range? These are the things that define true money movement. And these are the things we have to look at. And for those of you who are familiar with Chaikin money flow, that's what this entire indicator is based on, is tracking all of those things together. So now we use an indicator which is based on Chaikin money flow, which is called Twigs money flow. Okay, now the Twigs money flow indicator tracks all of those things. It looks at whether the money is, or whether the volume is going up, accompanied with price movement. It looks at whether whether it's making new highs or new lows and how frequently. So this is an indicator of smart money, because the only real way a stock can go up is if the volume of the market, the 80%, which is high frequency traders and smart money, is supporting the move. And if it supports the move, all of those things should be happening. If they're not, what we're going to see is this indicator, this green line, will go down. And as you can see here on the chart, ever since 2006, the money flow was going down as the smart money, as the stock or the market went up. So in other words, we all call it the crash of 2008, but it's actually the crash of 2006, because when it started happening was in October 2006, and that's where the signs were. Now, we didn't, at Acorn, we didn't actually figure this out until June 6, 2008, which was here. And that was when the Twigs money flow had broken below zero. And that was when we spotted the two head and shoulder patterns forming. And that's when we had told all of our students, we're getting the hell out of here. That was the warning sign. But but what we should have seen building this entire time was this head and shoulders and the divergent money flow significantly. So let's fast forward to current times now. That's what we're all here for. What you can see now is that we have had a rally in the same kind of channel from 2011 through to 2015. That channel has been broken. We have tested resistance from beneath and we have failed, or we have supported the resistance. Inclining money flow to significantly divergent money flow right there. Same kind of build-up period, same kind of breakdown. If we look at the pattern, we're likely dealing with a head and shoulders that is building in the same way, which is a declining neckline. And if we look at where that neckline would take us, we can measure it from there forwards. And what you'll see is we start looking around this, and that's actually not measured. Always measure from the bottom of the candle. We're looking at a 1600 target. Okay. Now, how do we justify the 1600? We have proposed that there's a possible head and shoulders here, but how do we start to confirm that our idea might be right? Well, we start to look at other evidence of that level of significance around this 1550 to 1600 level. So let's go back once more and talk about how important history can be. And let's do a Fibonacci retracement from the lows of 2011 where is the 50% Fibonacci? 1605. Where is the 38.2% Fibonacci? Right at 1600. Now, that is when you start to see correlation that close with the pattern and the indicators, that is when we start to get excited. And based on that head and shoulders pattern, you can see that where we bounced today was exactly where the neckline of that head and shoulders was. So these are the key things that we need to be looking at. Now, there's a couple of other ingredients that we can now start to add to the mix. So what do we think of the market short to medium term? Well, I don't think that the support here will have much value. I think that we may see a rally into Friday, and then it will collapse again from there. The obvious target that we're looking at where we're going to start taking profits on the shorts that we have is around 1810. That's where we start to reach the neckline, and that's where we get a more significant potential rally from 1800 back up to 1900. So that's the short-term view. So what we want to look at is one more other thing, which is the high yield bonds. So I'm going to bring that up on the chart. Please let me know when everyone has that. I'm going to bring it up at a long-term scale. Okay. Please let me know, everyone, when you have the high yield bonds up on the chart. So, high yield bonds are an indication of the smart money investing in the economy. An indication that the big boys and girls out there believe that businesses are worth investing into, and therefore high yield bonds go up. HYG is an ETF or a representation of that money flow. And if the market, if the smart money believed in the strength of the economy, you would expect this to go up. In fact, it did. When it bottomed out in 2009, it rallied all the way up until it started to peak in 2013. Now, what happened, ladies and gentlemen, in 2012, 2013? What was the major change in the US economy around that time? Any guesses? Yep. Quantitative easing. And that was the key thing that changed the economy, and when smart money started to offload into risk investments. So you can see that high yield bonds have actually been dropping despite the whole time this market has in fact been rallying. And when you see divergence in that, as well as divergence in the Twigs money flow versus the economy, that becomes a scary thing. And when you start to see this falling like it is, while the market has been set up on a precipice on the edge, that's when we start to worry. Now, I mentioned the insider trading. That's one other thing that we can look at. So, how many people here are familiar with insider cow? Okay. The first way to look at where the market's going from an insider standpoint Well, Finviz doesn't seem to be loading. Interesting. You can look at Finviz to begin with. Finviz is an excellent resource where, if it is working, you can go to insider information, and you can actually click on what the top 10% owners are doing, as well as what the top insider trading in terms of activity is happening. Okay, here it goes. So if we go to insider, okay, so we're at the top insider trade snapshot of what all of the big boys are doing. Now, this is the most recent activity. So it just tells you what's up in the most recent insider trading. Have a look at the ratio here. Green means buy, red means sell. These are the people that run the companies you're investing in. If they're not buying it, why would you be? Let's go to top 10%. This is where you can actually see what the really big boys are doing and actually see some underlying potential strength. Now, this is probably the first time I've actually seen any green in this chart in the last 6 months. Have a look. Most of the buying here is from Hathaway. Score it's in the other screen. You normally get a lot more information here. What that means is that there's not a lot of insider selling or buying going on in the last couple of weeks. Okay. Now, once you start to find out where the action is happening, then you can start to research it in Insider Cow. So it's insider and cow, like the animal. And then all you need to do is type in the symbol, and we'll do just bought recently. Just give me a second here. Yeah, Halo. Now this is one we bought puts on. Okay. So this isn't the one. ALNY. This is one we have puts on. But this was more of a technical move. We'll have a look at that anyway. Own puts in this. But once again, have a look. Stock, let's take the moving averages off, clean the chart up a bit. We had an ascending head and shoulders pattern. Measured the difference between the head and the neckline and repeated it below. And that dictated a drop from $17 down to $13. That was a 356% gain in buying the January $15 puts. And we bought those back on December 15th. The one I was going to mention to you though was ALNY. Now, once again, looking at this pattern, we had a rising wedge that was building in towards that $100 mark, and a very simple trade. We measure the distance between the top of the rising wedge and the bottom. We duplicate that, sorry, 1 second. We duplicate that beneath the breakout point. That gives us our target. And so therefore we had a target of a drop from around 95 down to 80. That's $15 on a $90 stock, which if you're in the option, which we are, and selling now, was immensely profitable. Very short-term move and just simply trading the pattern as it is. Okay. Similar thing, and part of this, to bring it back to what I was speaking about before, was looking at the time frame of the selling going on. Now, as a biotech stock, something that should be immensely speculative. In other words, the insiders should have a high degree of confidence in their own company if if they're in for a penny, in for a pound, so to speak. The runners of a company that have faith in their drugs is for them to be offloading millions and millions of dollars, all at a very technically opportune time in terms of the charts. But that is exactly what we saw. We saw not just one person selling, but the CEO, the director, the executive vice president. We saw a bunch of selling, all coming in heavy load. So that was one of the main reasons why that technical pattern was so strong, was it had no support from the insiders themselves. If we go and have a look at Goodyear Tire, this is another stock that we shorted the hell out of. I bought puts and took a $50,000 short position, as well as about a 10 grand put position on this stock, because right where you see the arrow, because this stock was once again in a rising wedge formation, broke down, tested the resistance from beneath, and then just crumbled. And what do you see from the smart money? Failing. Any newer trades? Absolutely. I shorted Canadian Solar today, CSIQ. My, 1 second, let me go to my account here. Canadian Solar, I have a target of 1937.47, and my stop loss is at 25.43. Let's have a look at another one. Let's look at LGF. It's a little bit older. Lionsgate Entertainment. Has been one on our shortlist for quite a long time. In fact, since November 13th. Right there, well, actually there. Again, you can see that divergence in the money flow. Another one of our alerts from last night was Let's have a look. VNO. VNO is Vornado Realty Trust. These ones we're looking at the March $90 puts. One of the ones we published last night in our stock alerts. Again, you can see the divergence in the money flow, stock rallying, broken the primary trend, and the money flow has been evaporating ever since November. We can look at WMGI, another one from our alerts last night. Right Medical Group. This is another ascending wedge or rising wedge. You can see it's broken down. What do you see happening? As it's going up, smart money is selling to you. If you see this indicator going down, you're being sold a bunch of you know what. Now, it may recover, but why buy a stock when it's going down against the uptrend when you could buy one where a stock is going down against a different trend? Look at this one. This is one that we bought calls on, and we traded the stock as well. Have a look at this. This is the perfect example where a stock is declining very fast. And look at the scale. This is going from 10, 8, 6, 4. It's losing 60% of its value, but the entire time, money flow is telling us the smart money is buying. And it did. And this is where we got in here. First trade. When it broke the 9-day moving average. And it's been going ever since, even in this bad market. So what you need to start looking for is not what the market's doing, really. You do want to look at the market's doing, but look for the individual personalities of the stocks that are going to make you the most amount of money. How and where do you get your stock alerts? We have designed our own. That's what we're known for. We are known for technical analysis scans that look for when smart money is coming in, when the stock is going down, or when smart money is flooding out when a stock is rallying. And I'll tell you a little bit more about our service here in about 5 minutes, if you want to stick around. Money flow, what is the tool study? How do you get it? Twigs money flow you can get in incredible charts. We also have programmed it into TradeStation, Metastock, TC2000. I think that's it, but that's as far as I can remember. But yeah, I think those are the ones. But yes, we provide those algorithms for you to install them into other applications. What I'll do is I know we've got about 15 minutes left here. So what I'll do is I'll tell you a little bit about my pitch, about where obviously this hopefully leads to for you. And then after I've done that piece of the slideshow, we'll get back to some questions. So the core thing that we want to obviously get to you is an idea of what we're focused on, and that is scanning. It's really about efficiency. And I may just have lost you there for a second. We'll just bring that back up. Yeah, it's really about efficiency. Because you can spend a lot of time trying to find the right opportunity. And I know that Fausto and CTU does a fantastic job in doing a lot of fundamental-based scanning, looking for those high volatility opportunities pre-market. What we're about is a complement to that, where we look for scanning opportunities, where we run specific scans that look for exactly the type of trades I've just shown you tonight, and try to identify when the highest probability pattern is occurring, where money flow is flooding out or in, depending on whether we want to buy or sell, and sell. And the idea of this is to accommodate this into a swing trading strategy or option trading strategy, where we can predefine where we're getting in, where we're getting out before the market even opens. Now, this is all that I do. So this is very possible. This is how I've built my business and my career as a trader, is to believe that that the market is not chaotic. It is organized chaos. And if the algorithms operate on rules, then why aren't we? Why are we sitting in front of the computer all day long as our only source of income, when you could also complement that with some swing trades that just sit there and look after your money when you are doing other things? So I still day trade very passionately, but what I do like to know is that even if I don't want to, I can have my money working for me as a strategy. So without knowing consistent variables as to why you buy or sell a stock, without having a recipe for the decisions you make as a trader, you're never going to have consistent results. Now, you guys are a group here, so you do have a lot of very good fundamentals there and techniques that you should be employing. This is the additive as to how we scan for technically sound opportunities. Okay. How many people here are using a scanner on a technical basis? Or how many people are not? Okay. I didn't get into trading because I wanted to work hard. I got into trading because I wanted my money to work for me. And I remember telling my father when I was about 16 years old, I said, "Dad, I want to be like Bill Gates. I want to make that kind of money." And Dad said, "Well, there's only one Bill Gates." And I said, "Well, there's only one John Seville," being a little arrogant little 18-year-old or 16-year-old. Look, I mean, trading shouldn't be work. Trading is about, well, I think, this is my own personal opinion, I think that trading is about trying to make your money work for you so that you can enjoy your time. And so you might call me the lazy trader. I'm quite happy to make less money. I'm quite happy to make 20% less money, but to work 60% less at the time. And that's, I guess, what this is all about. It's about trying to combine all of the knowledge and power that you've learned so far, and be able to just find you knowledge that you have too, and just find things quicker and understand how you're operating. So the course that we have put together is something that is probably been the most successful course we've ever done. We've been educating and trading, well, This is all about finding the perfect storm, and the course that we put together is 4 2-hour lessons that you get on demand, that you can access immediately. And what we do is in the first lesson, we take you through and show you all the rationale that goes into how we design the scans. So it's not about giving you the magic beans. We haven't designed some magic indicator that's going to just print dollar bills out of your CD-ROM. The most important thing you need to know if you're going to be a trader is not what the magic beans are, but why things move and why things work. So my career has been spent developing scans, efficiency. So as we teach you to scan, you'll find that the first 2 hours are really focused on teaching you why we designed the scan this way, so that you have faith in it, so you understand it, so you have confidence, so you're not just following things blindly, hoping things work out, because we all know how those work out. The rest of the lessons are all built around enforcing the things that make it work. So proper trend line drawing skills, pattern recognition, what are the highest patterns, what are the most probable trends that we want to look for, and then what we do on top of that is on top of those 8 hours of instant access that you get, we also invite you to our live lessons, which are every Tuesday and Thursday, okay, at 4 p.m. Pacific. They're recorded, and we talk about our everything that I publish to you is something that I'm investing in with my own money. So last night when I sent out an alert on DNO, WMGI, CSIQ, those are all stocks that I put my own money in today. So each day what I do is we do the Tuesday and Thursday hour-long sessions, but each day, every day, we actually send out a video about 10 minutes long, alerting you to what we're going to buy with our corporate account the next day and where our entry, exits, and stop losses are. Obviously, the core of the value is the course itself. And this is where we basically, again, go through all of the rationale behind why we trade the patterns we do, how we design the patterns, what the specific rules are for getting in and out, and this entire course is focused on how to ultimately plan without taking too much risk if this market absolutely crashes. And there is a huge chance that it will. We have never faced such significant problems, and we have printed our way through the last 5 years, but the market doesn't believe it anymore, and the high yield bonds don't, the smart money doesn't, and we're seeing the big boys like Priceline, that was the last one to collapse, finally fall. And this is I promise you, ladies and gentlemen, this is an excellent way to start adapting your fundamentals and technicals together. Can we register online? You certainly can. I'll bring the link back up. It's tradethirsty.com/now. Let's have a look. Greg says, scan matched to trade plan. Yep, absolutely. Give Google's not finding that link. Let me just try it myself. It was working earlier. Yeah, it's working for me. Just instead of typing it into Google, just type it into your address bar. I'll pop it into the. Okay, so let's take some questions. I would love to talk about anything you'd like to talk about. I'm pretty open book about what I'm trading, or what I think about the market, and I know you guys have, and guys and girls have given up your time to be here to listen to me speak. So, what would you guys like to talk about? How long will we have access to Tuesday, Thursday talks? You get a month access as well as a daily video on what we're trading for $9. So when you get the $97 enrollment for the 8-hour course, just you'll get a $9 option to add that, and that's you can cancel it at any time. Just shoot us an email, or you can click the unsubscribe link. So yeah, just go ahead. Text alerts are resuming now that I've actually been traveling for the last 3 months, but we are resuming trade alerts, or text alerts rather, in this month. What does it cost after? Well, depending on how much service you want, there is a $59 option for emails only, and for one-on-one training, as well as the live sessions every week and so forth, is $147. So it's wherever you feel comfortable in between. But the most important thing I say to people is it doesn't cost you anything if it doesn't make you money. So if you don't make significant returns in the next month, cancel it. But just pay attention to it. It's amazing how many people I talk to that have taken our trial in the previous months. We killed it this month. Like I put $32,000 into options in terms of a few trades 7 days ago that are now worth $62,000 today. All of those trades were sent out. So this is a great market to be capturing the crash. Not to plug that saying, but I kind of am. But I mean, it's for $97. I'd be very surprised if you didn't make that tenfold within the next 2 weeks just from following what we're doing. Would HYG be a good put candidate? Brian, just like Josh was speaking about earlier, I'm not a huge fan of trading ETFs. My reason personally is that I believe that it's not a stock market, but a market of individual stocks. And if we believe that the market is fundamentally flawed and will go down, then I prefer to find the weakest stock and short that or buy puts in that, because even if the market goes up, that stock could still go down. So I'm kind of buying insurance. Whereas if I'm buying an ETF or I'm buying the market, then I'm 50-50, and I'm dealing with a lot more manipulation than I am with an individual stock. So no, I wouldn't buy HYG. I would find other stocks such as HOLX, HUIHU. I can show you some of the ones that I'm favorable of at the moment, but or ROK. There's a bunch of really great ones. If everyone in the market is buying puts, can everyone end up losing? Of course they can. That's why you have targets. You should never enter a trade without an exit plan, and never let your exit plan be the 100% possible return. So when I'm looking at Fibonacci's, for example, I am always taking profit at the 33 and the 50. And then I'll let the house money ride to the 61.8. You have to have rules. So if you go for big trades, that you're always looking for the 61.8 Fibonacci, or you're always looking for the home run, okay, fine. But accept that those will only happen 2 out of 10 times maybe. So make sure you minimize your risk on the downside that makes up for those losses. There's no such thing as a bad strategy. The worst thing is no strategy. And what we're teaching you here is how we develop ours, what the risk rewards are on our strategies, and how they're justified, and what we've tested them over. So that's what the I think that's the most important thing with whatever you trade is to stick to something and don't bounce around too much. Now, fundamentals, awesome. Technicals, very important. Both of them are very powerful. So that's why, especially knowing that you guys have been through a lot of these workshops with CTU, and you've been well educated on the fundamentals and how to trade and look at level 2 and 3 data. This is all about how we try and find those opportunities to apply. All right, so let's see how much time we have left, if we have any. Oh, we are just about out of time. So if there are any other last questions, please do send them to me. Look, and if at the end of this, I realize that the audio has been a little bit choppy. I do apologize for that. I'm not sure why. I just bought a new headset yesterday, so that might be the problem. But and you monitor our trade alerts, and you don't find the value, send us an email. We will honor the 100% refund policy, and refund the money right back up to you. But I hope that you really feel that you've gotten some value from this, and thank you, Scott. That's awesome. That's really nice of you. Are you on a beach? I'm actually in Playa del Carmen. Yes, I am in Mexico. As I said, I started trading so I could travel. What kind of teacher would I be if I didn't live what I was preaching? I've been in Playa del Carmen the last 2 weeks, and Australia for the last 3 months. Back to Vancouver in about 6 weeks. So come join me. Tell them about it. Yes, I went great. Yeah, thank you, Scott. I knew it was you. We did go great white shark diving in Australia 2 weeks ago, and got attacked by one of them in the cage. Well, look. I'm sorry we can't spend more time together, but look, give us a go. There's no risk to you. If you don't like it, you find it's not worth your time or your money, let me know, and either we'll get on the phone together and I'll spend an hour with you, or we'll just refund it right back up to you. So just the link again is tradethirsty.com/now. And I'd like to thank everyone over there at Cyber Trading University for putting us on tonight. And I wish you all very happy trading in these interesting markets. Yes, thank you, Scott. Yep, I'll just add this one thing here. For those of you who are registering, we will be having an alert session tonight, which will be at 7 p.m. Eastern. and we will be going over all of our current trades and where we're at with them. So that make sure you do. If you are going to register, I would do it today, so you can be part of that. We are on the brink of probably another big leg down. Thank you for mentioning that, Scott. Cheers.